The S&P 500 and the Nasdaq 100 obviously were trending basically at highs. We're pulling back, but the biggest thing of this week is going to be the Fed meeting, rate decisions, what's going to happen going into summer, and when are we getting those rate cuts. But before we get into that, we have some news as well on a few stocks that were pretty interesting on the day, and I do want to chime you in. First up, Apple, Google partnership for their iPhones, pretty big deal. So basically, if you don't know, Apple's in talks with Google to get their Gemini AI. Just to give you an idea, this is basically like the competitor to ChatGPT. And I want to say right now, this is one of the most surprising partnerships maybe of the year that will happen all year. Because I would say Apple and Google are a little bit of competitors in a lot of areas. But the biggest thing here is Apple and Google have been losers in the AI race. And I think that this is a step in that direction of we're losing to Microsoft and Nvidia. We got to step it up. We have no footprint. We're suckers. We're trash right now. We need to join up. What better than two of the biggest companies in the world? I think that's the focus here, right? Personal opinion. That's what I'm looking at here. And I do think this will work out. I'm going to tell you right now. We'll go over those stocks here in a little bit, but keep that in the back of your mind. We'll come back to that. Now, when we look at ES, a few things really quickly. Don't want to spend too long here. You're just basically trending sideways. If I go to the daily chart, guys, you are trending sideways. It's really that simple. You've basically trended in between, highs and then the low of like 51.28 here on the new futures chart. Really, we'll even kind of condense it down to like 52.35. So around 100 points back and forth. We've basically just trended here, as you can see. Nothing crazy, nothing amazing, okay? And really, you're making higher lows to the upside. If I go into Nasdaq, I think Nasdaq's probably had a little bit more of a pullback here, all things considered, right? Not as bullish structurally. You've made some lower lows basically since March 8th. But yeah, that's where you're at. Not terrible, not great, but all things considered on higher time frames, it's still structurally bullish because you're making higher highs on the weekly and daily, and you're making technically higher lows right now. That's where we're at, just kind of flatlining at highs. I'm giving you, for instance, the last time this happened, you had some action here back in early November where you pulled back and then rocketed up. You had that big pullback back there, but ultimately not freaking out just yet. However, I do think there's a reason to freak out potentially on this week, and we'll get right into that. Now, another area that I've been watching pretty closely has been the Dow. And the Dow is also giving you some signs of hope here, right? So let me go into a little bit why. So if we look here at the Dow, the biggest thing is that you're clearly making higher lows. It's clear as day, clearly there. The Dow was getting a nice push as well into the middle of last week. I think the Dow has been pretty influential of giving you overall direction, which hasn't been the case for a while. It's been really Nasdaq that's led the charge, and I think Nasdaq has led the charge still. But what's interesting here is when the Dow gets some momentum to the upside, it really carries ES and the SPY, because some of your biggest SPY names, such as Google and Apple, just haven't performed that well until today. So it's really important that the Dow shows you some signs here. And I do think inflation data has a large impact on the Dow specifically, especially with energy, delivery costs, things along those lines as well, housing, oil, etc. So really important to understand that there also. So giving you a heads up, if you don't know, you have your rate decision on Wednesday. That'll be the next video day, just to give you an idea. I'll give you guys an update then. I'm going to give you a quick insight to what's probably going to be said. We've had bad data now for about 2 months in a row. And I think PPI was really bad. I really believe PPI was terrible. It was bad. It's the worst you saw since September. I'm giving you for instance, going into the SPY. What? Also, too, if you're interested in what's happening here with our indicators down here, you can see our indicator here. We also have our scalping indicator down here with our volume. I don't use it during the videos just because it's really for scalping for me. These are all available on LuxAlgo. The link is down below, so make sure you check them out. It happened in September when we started getting bad data back here, August, September, we pulled back. I'm not saying it's going to happen because things are a little bit different now. Now, the reason why we're not going to pull back right now, and this is my opinion, you might get a subtle pullback. The things that will constitute a pullback will be the Fed really leaning against pausing rates. That'll be number one. Okay. However, I think the Fed is going to keep the same tone that they've had. We're just seeing how inflation goes. We're happy with it. We're close to cutting, the end. And I know you're saying, Tyler, doesn't that go against what everything's happened with this data? It does. However, the past few data readings, the Fed continues to come out and say, we don't really care. It's going as planned. We know we're not going to drop there immediately. Our base goal is to get down to 2% or around 2%. We're not going to cut rates when we get to 2%. We're going to cut them a little bit before that. So we still look decent, like we're on plan. We need to see more data come in. That's what the Fed has been saying anytime things don't go well since, again, November. That's what they've said. And the markets have reacted well to that. Anytime we have good, readings from earnings or any good news to come out, it is benefits and puts fuel on the fire. And that's just what's taken place. Now, I'm going to show you some things that are concerning that if rates don't get cut sooner than later could cause some extreme pain. Okay. Number one, credit card rates. So this is credit card defaults or delinquency on credit cards. Now, people like to compare right now to 2008. I will say this is the largest spike, as you can see with my fat ass head here. Wait, let me move my head over really quick. Let me move my head a little bit down. As you can see, this is the largest spike that we've had from 1.5% ultimately into like 3%, almost doubling from the course of 2021 into now. Now, it's worth mentioning, rates on these credit cards rose dramatically. So there's a reason why, if you look here, like, oh, well, you're doubling and delinquencies. Yeah, but you were also down at lows for the past like 30 years. So is it that bad? Like even in healthy markets into, before the 2000 bubble, right? You were still at 3% delinquency. So it's worth mentioning you're still on that downturn, right? And if you go back to 2008, 2010, when you had the financial crisis, you were at 3% and you went all the way up to like 6.7%. So there's definitely a difference, okay? And the idea here is this will start to drop down delinquencies once they cut rates, right? Because all we've seen, again, I say this all the time, but for some reason it's hard to comprehend, is all we've seen as of recently is raise on credit card rates, right? That's what's happened, right? Rates have only gone up, okay? You go back to 2008 and pretty much any other market, it's up, down, up, down, up, down as far as the rates that you're getting on any type of loan. This is the one time this has ever happened in the past 50, 60 years. So important to understand that. Now, I'm not saying this isn't good. I'm not saying this is good news, but I am saying if we cut rates in the summer, it helps out tremendously. If we don't cut rates in the summer, we could see numbers going up to 5% easily, which would cause a lot of turmoil in the banks, the whole banking sector, and then the market as a whole, obviously, and it would eventually come back down to these big companies, Amazon, Netflix, etc., that people are spending all this money on, continuing to bolster these earnings. Number two, the unemployment rate. Again, people like to compare 2008 to whatever to right now. Okay, again, back in 2008, you rose from 4.7%, which was your baseline normal unemployment number. I will say when we look at unemployment numbers now, they're different based on how we categorize them. They are different, so I don't want to seem like I'm manipulating anything, but you went from 4.7 into 9.6. That's incredible. And that was in from January 2008 to January 2009, you rose literally, 3% almost. And then over the next 8 months, it was another, it's peaked out at 10. If we go to, what happened in obviously 2020 with COVID, went from 3.5 to highs of 14, which were highs we haven't seen in fucking decades. So maybe even ever. Yeah, ever. Learn something new every day. Okay, so that's disgusting. Okay, so we obviously don't want that to happen and understanding where we're at here. So again, as we go into this, you're at 3.7 and we just hit 3.9. Now the Fed has said they want to get to 4.4, 4.5%, and that'd be really healthy for that. But again, this is in line with what the Fed wants of a slow increase, right? We were at lows of at one point, we couldn't get above 3.5, right? Again, it's based on how we measure this now. So it's definitely interesting how they, include all these. I think it's a little bit manipulative and it's all a politic game, but it is what it is. So again, you are rising. So on the counterpart of what's happening with some of this bad data, on the other end of it, you're having what's happening here with unemployment rate, which is rising, which will continue to rise. It will. Okay. Now this is where everything kind of hits the fan when it goes to all that data and what's happening there. It's your 30-year fixed mortgage. And this is where things, in my opinion, get a little bit tricky. And this is where everyone gets confused and we like to say, oh, the housing market is going to crash, this and that. Again, just taking you back so you don't shoot me or get crazy or attack me, okay? Your mortgage rates, again, back in, let's go to 2008, as you can see right here. Even though you had a housing crash, important to remember, we have a very different circumstance from 2008 to right now. Your mortgage rate dropped in 2008 dramatically. 2010, it dropped. It's because the issues were totally different. So if I see one more person like say, oh, this is the same thing as 2008, I'm like, it's everything different. There's nothing similar right now to 2008. Okay. The demand for buying a house right now is very high. Okay. So let's also go into that. Now, again, I want to zoom into present time of what's happening to rates. Okay. Now, this is my opinion. I would love to have an educated conversation in the comments if you'd like to have a discussion about this. As you can see, we were sitting at a beautiful point of 2 to 3% as your average mortgage rate in America. Okay. Anyone, and the average rate right now in America, I think is like 4.8% total for a home loan. So it's really good. No one's going to have to like file for any type of foreclosure with that type of rate right now, in my opinion. Okay. If you look at this number, okay, you went from 3.25 up to 7 and then up to highs of 8%, and you've dropped dramatically. Now, what we saw during this drop was a spike in buying in homes, and the home market spiked a little bit. And then we saw rates come back up, and we saw the home market slow down again. Okay. Again, this is my opinion. When we see a rate cut, this was without a rate cut. Very important. This is just with pausing rates. Okay. You dropped, and the market was healthy. With the rate cut, this number should drop dramatically. Now, I'm not going to say you drop down to 4%. Let's hypothetically say best case scenario. With like 2 rate cuts, you drop down to 5%. Hypothetically. The market will freak out. The average home buyer, person renting, etc., will have a freak out, and they say, guess what, guys? We have to go buy. We have to. Now, the Fed is encouraged right now to cut rates because of what's happening with rentals. Because when we have the rates sitting this high, first of all, homeowners or home buyers are deterred from buying, so they just rent. And as long as rents are being met, or as long as these apartments, rentals are being occupied, high occupancy, 90 plus percent, well, guess what? If the demand is there, why would you decrease the value of your product? If I have 100 apples and I say, they're only really worth $1, but I can sell them for $1.50, and every day I'll go out and I'll sell 95 apples. Why would I lower the price down to $1? Why? I would make less money overall if I did that. I'm still making more money, right? And that's what's happening with the rental market. People have to live somewhere. Spoiler alert. Our population is only rising. Again, this is what's happening. If you don't believe me, just go look. The statistics are there. So I just want to break this down for everyone. So again, when they cut rates, and I'm trying to highlight, there's incentives for them to cut rates, and then there's some scary factors. Now, we've seen the factors of what they're scared about, that inflation in certain areas might peak again. But areas of inflation with rents and cost of living like this will only continue to stay high, if not rise, as long as they do not cut rates. They cannot drop. Rent prices cannot drop with this happening. If they were going to drop, they would have dropped, and they would have dropped dramatically here in October through December, which historically, that's when you get your rental prices on the downturn, is in those winter months with the holiday season, which it did happen, but we saw them basically just spike right back up. Again, meeting that demand. But again, as we go into summer months, tax returns are coming in. Again, just don't shoot the messenger. Again, you have your tax returns coming in, potential rate cut. This could highly stimulate the home market and drop the value of rents. Again, as people leave their rent properties to go try to buy homes, which again, it's a whole nother issue. People buying homes at 5%. If you're in a recession, it's a whole nother issue. I'll get into that here in a second. And that's the long game, but this is the short game right now. The next 6 months, 3 months, whatever you want to consider. That's the issue right now. And that's why I think this could start dropping. And ultimately, if they cut rates and the home market caught some fire and people started buying aggressively, guess what? That would come right back into the stock market. Traditionally, when the home market and the real estate market is doing well, what else does well? The stock market. Go look at 2020, 2021, when you were sitting on a low mortgage rates down here. The stock market was booming, right? And this also goes into and giving you a different perspective on getting loans for small businesses, growth companies, IWM names, etc. Those are also areas that you have to be looking at. So hopefully this didn't this is probably a longer part of the video. So anyways, I wanted to break this down. Hope it makes sense and things you're looking for. Now, be on the lookout for some of these mentions in the Fed meeting on Wednesday. Okay. Very important that we're looking at all that. Now, going back to the chart, looking at visuals, looking at what we're looking at here. Again, as we go into ES, These are your key levels. I recommend taking a quick screenshot, whatever you have to do. These are your main key levels that I'm watching on the 4-hour and basically daily that I'm watching. I had a few more, but I kind of reduced them down for you. Now, if we go down to something like the 15-minute, you can see how you're respecting these over and over and over all day long, every single day. So they'll really help you day trade with ES. And then here's your NQ ones as well here on the daily. I recommend screenshotting on the higher time frames so you can see everything. But those are your levels as well. Make sure you take advantage of them while you have them. Again, we'll have them also posted on the newsletter, so check that out there as well. And as you can see, we're range trading within these ranges all day long. You can see how you're respecting them over and over and over. Now, broad market, people are saying, well, Tyler, are we going to go up or are we going to go down? And I don't ever want to be the guy that just blindly gives you an answer. And I don't want to be the guy that says, well, we could go up, go down. But going to the Fed meeting, I think it's very clear over the past 4 Fed meetings, it is a flip of the coin of what Powell is going to say and which direction he's going to take. Based on data, it should not be a good Fed meeting. But we said it at the last Fed meeting, and he came out and said, guys, it's going according to plan. We expected a rough patch. That's what Powell said, and the market loved it, and we shot up. So I'm not going to act like I know what Powell's going to say, but I'm going to tell you right now, if he voices those concerns, if he voices the concerns of inflation creeping back up and we might need to think about longer to pausing rates, then yes, you're going to have a downturn. But if he goes to the point of saying, well, unemployment's following our trajectory, we need to start potentially cutting rates still in June, hasn't changed our plan. We're still seeing that area where focus is maximum employment, et cetera, the same old, then the market's going to love it. Okay. So that's what you're looking for right now. Simple as that. Now, we're going to go into equities and stocks I'm liking, but really quickly as well, looking at the 30-year yield and what's happening here. So again, the 30-year yield is one of the best metrics of looking at overall what's happening with the broad market. And again, the 30-year yield is pricing in a not good Fed meeting right now. Why? Because again, you were moving down great until PPI and CPI came out. Once those came out, it was game over, and you haven't moved great since. And you see yields rise as well. Now, another big part that you're looking here is for when the 30-year yield gets below 4%, because when that happens, I think, again, the housing market booms. I think small caps can boom as well, and that's a whole nother thing we have to talk about. But again, that probably won't happen until we cut rates, most likely. You're still kind of trending a little bit of a bear flag here, but I don't, as you're above our key level of 4.4, I don't really care. And this is the previous high on the 30-year yield from 2022. It's been a very big metric, okay? So that's what we're looking for. We want to see us get below 4%, very important there. Now, on the contrary, when we look at that, with the yields giving us cause for concern, look what's happening here with the dollar. You're trending below the 200 SMA. And again, this couldn't have gone kind of better, technically speaking, because you're operating right below that key level. And we've seen some nasty rejections from that. So again, I'm watching very closely. I'm definitely not jumping into crazy positions. I'm not going net long, not going net short. Like I always say, it's better to react to what's given to you and then use our key levels based on that. Because we know if the Fed meeting goes well, we'll use those key levels to ride us back to the upside and trade the strongest names possible with the underlying trend. And if it goes bad, then we trade the weakest names possible with that underlying trend. So again, very important. But now we're going to switch over to equities and take a better look here. So again, Apple had news today, pretty nasty daily candle. You need to get above you have to hold above 176.3, 176.5. That's your massive level to hold above. If you can ever get that hold, if we can really mount above this, in my opinion, you're pushing back into with ease. I think you're pushing back into around 180. That's my personal opinion. Definitely be on the lookout for that. So that's what I'm looking at there. But as long as you're below this, you can go long. You have to be very careful. I'm not going short on Apple. I definitely think they're in the right step. I think they're focused on the right things. This is the reason why a company like Netflix and Meta bounced like crazy from those lows last year, right? And the year before that. It was because they focused on what got them to where they were, and they focused and they refocused back on the important things. And right now, Apple is focusing on the important things. AI and taking advantage of where the most opportunities in the market. And they're doing it with one of the biggest companies in the world. Important thing about that as well. Google, I'm not a huge monster fan of this, but if the market can get bullish, all you want to do is mount above 151.5. If you mount above 151.5, it's your previous high from 2021, 2022. You'll push into all-time highs with ease. Okay? So that's all you got to do. You rejected there today. The end. That's where you're at. NVIDIA, I had your conference. I think NVIDIA's conference was actually pretty bullish because they're now focused on a whole new type of data center for, again, another whole sector of AI. Monster thing that's happening there. Nvidia coming down, I don't care about it. I think it's good. You're still kind of in this pennant pinching, so we'll see. And I don't think you're going to really exit or pick a direction until after FOMC. What I will say is if FOMC goes well, I don't see how Nvidia doesn't push to 1,000. Going to tell you that. But what I will say on Nvidia is watch very closely for the stock split that will eventually come. It's going to come soon. Understand that. Be careful with it. So what you're looking for upside is a mount above 897. You hold above 897, 898. You look really good. You haven't been able to get like a 2 hour, 1 hour candle above that. To the downside, a mount and hold below 876. A hold below that is very, very bearish. Now, honestly, you could push back down into at least 863, and then your next target is around 841.5, 841.8, roughly. That's your next range down there, what I'd be looking at. AMD. I like AMD a lot, but it's a really simple chart to look at here. We said it on Friday. You have to get above 193 to be bullish. Until then, you're bearish. You're rejecting off of every key level. You're bouncing back to 184. Below 184, this thing could get treacherous. What I will say is you do have a little bit of a, you could argue that you have a little bit of like a demand down here around 181. That'll be choppy to get through. But in reality, this could easily push back into our 174 level. We remember how many times we tested that. It was literally a money play. But again, that's what I'm looking at there. Nothing confusing, nothing crazy. Netflix, honestly, one of my favorite plays. Today was our day trade on the day, so congrats to everyone that traded this one. We had a great push into both of our targets. But Netflix, in my opinion, is ready to push back into highs. It's one of those names, if things go well over the next few days, in my opinion, it's easy. I think this thing easily pushes back into 642, and then after that, you're trying to push back into all-time highs. That simple. Personal opinion. They are performing. They're killing it. They're getting price target raises, and their earnings continue to destroy. They're growing in a weak market. Very important to understand that. As far a weak consumer market, theoretically. So things you should be paying attention to and watching there as well. Amazon, I've lost a lot of interest here. You got to hold above 175.4. You're clearly holding below that. You're kind of pushing back down. Under 173.5, you're looking for 171 roughly, or at least 171.5. What I'd be watching there. Tesla, they had some news. You pop back up, but guess what? Key levels don't lie. Women lie. Your best friend might lie, but the key level will never lie. Again, when we look at key levels and what's taking place here, again, 175 line in the sand. You hold below that, you're bearish. You had to push back into it today, as you can see, and guess what? You're falling back down in the after hours. You're ultimately going to follow the market as well. Under 166, which was our original target, under that, you're very bearish as well. So again, I have no momentum, nothing to buy on Tesla, no desire, nothing but weakness so far. Yes, even a dead cattle bounce eventually. So again, going straight down, inversing the market as well when it was the strongest. So nothing to look at, nothing to touch there. Coinbase, Bitcoin, I'm going to go into here in a second. I think Bitcoin looks fine, to be honest, too. Coinbase, you're trying to hold them out 240. Below 240, I'm really scared of the pushback down to 212, 215. That's ideally where you'd like to hold. Like a company like MicroStrategy today, really big dip from like 1,800 all the way down to like 1,450. Concerning, but you're holding those lows as well. So the question now is, can Bitcoin bounce, and how does the market react as well? I still think Coinbase is the better opportunity since you have so much room back into highs. But again, you got to mount above 270, or you're looking for that test back at 215 to at least get some risk at that level there. No reason to get overcomplicated or super risky. Going into Coinbase or Bitcoin really quick. Bitcoin's really simple. I've charted this a lot. I posted a lot. You got to get above 69,200. Okay, $69,200, right? That's your previous high you established back here. It's been the line in the sand. Below 64K, you can expect some volatility to the downside. Above 69.2, very bullish. As of now, you're ranging sideways. You can't do nothing there. You're just waiting as we speak. There's no reason to get crazy because you're putting just risk on the table. Also, too, as you can see with Ethereum, you're just pushing down, making lower lows, lower highs on the 4-hour, 2-hour trend. So again, not ideal. So you're not getting resilience from that side of the market. You do have other coins like Solana and AVAX holding it very well, but I'm not going to go into a whole cryptocurrency video here right now. So those are the biggest areas in the market that I'm looking at. Again, Meta, one more name here. Very bullish in my opinion. Caught the upside the last part of the day as well in Discord. But what I'll say is above 494, you look really good. I think Meta, I think Google, I think Netflix, I think Meta, Microsoft, and Google, Apple really have room to run. All things considered, you have consolidated since the ending of February. You really have. on most of these names. And you're consolidating above previous all-time highs that you established back in into January. Great behavior. Exactly what we want to see. Consolidating above a resistance, above a support, is extremely bullish with how you're reacting. You've had multiple opportunities from sellers to step in. So again, that's why I say when I go into these Fed meetings, it's just like, you really got to see some bad news come out. You got to see the Fed really change tone, because there's no reason to try to time a top. Because if you try to time a top, you're usually going to get burned, just like if you try to time a bottom. That's how I'm trading. That's what I'm looking at. If you have questions, comment down below. I'll see you guys next time. Have a good one.